Hi there, we're Group 20 and we're going to be doing our presentation on risk estimation models. So I'm going to kick us off by going through value of risk. And so since the 2008 financial crisis, accurately estimating risk has become of paramount importance in the industry. In line with this, the methods of calculating financial risk have become more scrutinized than ever. People now know the potential devastating consequences of underestimating credit risk. Value at risk is one of these methods and has become the industry standard risk measure. It essentially measures the maximum possible loss over a given holding period within a fixed confidence level. However, despite its popularity, various academics have come out and written articles pointing out flaws in value at risk's methodology. Many of these articles also go on to propose expected shortfall as a superior alternative risk estimation technique. Expected shortfall measures the average of all the losses greater than the VaR level. In their article, Yamai and Yoshiba cite two reasons why expected shortfall should be adopted. It estimates the tail risk beyond VaR level, and it is sub-additive, and therefore more coherent. So, in our project, we go on to test different methods of VaR as well as expected shortfall to determine their performance and select the appropriate method for our portfolio. So I'm now going to hand you over to Uzair, who's going to go through the data and methodology.
Right, for the data used, so we have a period of 15 years from 2000 to 2015, and we had 4 portfolios. For the equity, we had the S&P 500, and that consisted of the 24 stocks, and they were based on the Sharpe ratios. We had 8 industries, and we picked the best 3 out of those based on the Sharpe ratio. Then for the bond, we had from corporate bonds and government bonds from across the world, and that was 6 bond ETFs. And for the combination, we had 70% of the S&P and 30% of the bond. And our fourth was our SuperDex, the same compilation as assignment 1. It was various ETFs for the purpose of maxing out diversification, and Zach will go through the methodology.
All right, thank you. So we calculated 3 different types of VaR, moving average, exponentially weighted moving average, and a GARCH, using both a normal distribution and a t-distribution. So for the exercise, we created naive portfolios out of the 4 different assets we had there. And we then calculated the VaR using a rolling window estimation, and we did this at the 99% confidence interval and at the 95% confidence interval. We then obtained violation ratios, which we subjected to the Bernoulli and independence tests to test their statistical significance. And then we calculated the expected shortfall and the average unaccounted for losses. These are the portfolios we used. You can see the efficient frontiers and then the naive portfolios there, the dots. We did this because the S&P 500 tracking portfolio, when we regressed it against the actual S&P, the returns using the R squared and the coefficient, the beta coefficient, when using the optimized portfolio and the global minimum variance portfolio, gave poor results, so it wasn't a very accurate depiction of the S&P 500. So then I thought of a different way that was easily replicated across the rest of the assets, and that was to use a naive portfolio, which gave us R squared of 89.9 and a beta coefficient of 1.09 with a 0 alpha. So I felt that that was reasonable in giving us a good depiction of the S&P 500. So our application of our results and our findings were that for the 3 test portfolios, being the S&P tracking portfolio, the bond portfolio, and the combination, GARCH at the 90.
Can I ask you a question? So the S&P tracking is a mean variance tracking?
It's a 1 over N portfolio, so
okay,
there's 24 stocks.
So that's the naive one?
They're all naive, yeah.
Okay.
So if you look back here, so they're all naive. You can see where their efficient frontiers are, and then we selected points that are less than that, but that gave us, I didn't want to replicate, I didn't want to choose the naive S&P tracking port and then calculate the VaR and test its effectiveness and then test it against, see how that compared to the bond portfolio.
You see, because I
using
think something interesting that you will find if you if you actually pick a portfolio, right, on the efficient frontier, okay,
Yeah.
and then you compare it with either with the equally weighted portfolio or with a market weighted portfolio, right, then you will see that there is a big difference, okay, in the tail of that portfolio.
Yeah, so
I'm making a bet
we
with you.
say that in
Yeah.
the potential for
Right.
further
Okay.
work.
Okay.
Yeah.
Okay.
So what we found is that of the 3 test portfolios, that's excluding the super DEX, which is supposed to be our final result, Garch at the 95% level, using a normal distribution, was really the only one that was consistently significant. It was significant for all of them and gave the best performance, undoubtedly. The super DEX, though, had an interesting issue. We had the Garch at the 95% with a normal distribution and the T distribution both being significant with acceptable violation ratios that were approximately the same distance away from a perfect score of 1. We also had at the 99% level a violation ratio using a Garch with a T distribution that was just out of the acceptable range, but offered pretty good performance. We had a bit of a shortcoming, though. We had a bit of a shortcoming where I couldn't calculate the expected shortfall using a T distribution, so we couldn't fully decide which model to choose, and that led us to believe that definitely expected shortfall needs to go into the decision of which model to use, and it really comes down to weighing the benefits and understanding your risk appetite, so you could have a model that's more accurate but has a higher increase in opportunity costs, where you're having an over coverage and you're losing out on the ability to fully invest your assets due to having cash to cover any expected losses. Or you could take a more aggressive standpoint and have a higher chance of failure but total more usage of your available assets. I'm going to pass you on to Bhavya for our potential for further work.
After running all these tests, we were wondering that does optimizing the portfolios have an effect on the VaR? Because John Cotter says that there are certain portfolios that do not compare well with the VaR, and we'd also like to use other models to test our data. We were going through papers, and then we came across something called the eGarch. We'd like to implement that and see how it tests with our data. And
With the tail? Okay. So if it's skewed or, okay.
And then lastly, we'd like to, there are other industries that are also, measuring risk. It's not only that we want to measure the investment risk. So we'd like to see how they do it, and maybe there are some components of their methods that we could implement with the VaR and come up with a better model. So thank you, and any questions?